Hey everybody, welcome back to 5 Minute Financial Markets. Well, we had a big down day today, not necessarily percentage wise, but in terms of market psychology and breaking supports. This was a pretty bad day. It started off this morning before the market opened with a slightly higher than expected PPI number. Really, it was just a tenth of a percent higher than the expectation, but that was enough to send the market gapping lower. Take a look at this pre-market action. This is where the PPI number comes out. That giant red candle there dropped all the way from 398 in the pre-market down to 394 and change. We wound up opening right around 395. Moved higher at the beginning, and it was looking like we might retrace and fill that gap. But then around midday, market turned and we started heading lower. Look at this bounce. I mean, I've talked about this almost every video. The $5 increments on the SPY. Look at that support right down to within a penny of 395, and then bounces back up. But unfortunately, that wasn't enough to hold it, as toward the end of the day, a wave of selling came in and pushed the market down to close at the lows of the day, 393 and a quarter. 393.28 was the actual close. This is really not a great sign. All of this selling into the close, heading into the weekend, that really shows that the market doesn't want to wear this risk in the weekend, especially with the big news items coming out Tuesday and Wednesday. We've got the CPI number, the Consumer Price Index, coming out before the bell on Tuesday. This is the biggest, most important inflation number, and this is what really, more than anything else, informs the Fed's rate hike decisions. And speaking of the Fed, the very next day, Wednesday, December 14th, at 11 a.m. Pacific, we get the Fed interest rate decision. Not a lot of suspense here. It's going to be a 50 basis point rate hike. The market is pretty much guaranteed that. What really is undetermined at this point, and what people are really waiting to find out, is what is the Fed statement and what is the verbiage that they use at the press conference 30 minutes later. That's where they are able to drop little hints about the direction moving forward, how hawkish or dovish they're looking, and whether these rate hikes are going to stop soon and possibly lead to an actual pivot and reductions in the interest rate. So let's go back to the SPY chart, taking a look at the daily chart. Now, we've been talking about this parallel channel for weeks now. Ever since this bad CPI number in October, the S&P has been trading in this upward trending channel, and the last 3 days it touched the bottom of this trend line but found support and bounced off. Today it did the same thing. It found support at the bottom of the trend line, but towards the end of the day, in that late day sell, it actually powered right through and closed right here just below the trend line. Now, that doesn't necessarily mean that that channel is dead. We could rebound into it on Monday and the channel is still intact. That happens all the time, that price action will pierce outside of a trend line or a channel and then revert back in. But if it doesn't, then there is a lot of room to the downside, especially if that FOMC meeting comes out more hawkish than people are expecting. We could see a move all the way down to, potentially down to 350, but certainly down to fill this gap around 385. Let's take a quick look at the volatility index. Again, like it's been doing for the last several days, it's chopping right around this 22. This has been a key level of support and resistance, and you can see that it's just showing this indecision the last few days, just chopping around a little higher, a little lower, but always closing right around that 22. And I suspect it's going to continue to do that until the CPI number on Tuesday and the FOMC on Wednesday. Same thing with the US dollar. Another day of indecision, a little bit up, a little bit down, and then closed pretty close to the open. One asset that is not showing indecision, however, is silver. And we've been talking about silver a lot, going back to 2 weeks ago when it started to break up into this shaded area of previous support and resistance. It powered right through that, broke out through the top, and established a new high today, just shy of $24. I've said this before, there's nothing stopping this from getting back up to the $25 an ounce level. I mean, we're a little over $1 away. And the only thing that I can see to slow this down would be a strengthening dollar. So if we see the US dollar curl back over and come back and retest some of this previous resistance, that's the only thing that I think could slow down silver in the short term. But medium to long term, I still like silver a lot. Once again, looking at the Fed Watch tool, this is what the market is pricing in as the probabilities of Wednesday's rate hike. This is a 50 basis point hike, and it is the heavy favorite, over a 3-to-1 favorite. The other possibility is a 75 basis point hike, but much less chance of that. So I think we can count on a 50 basis point hike. I really do think the Fed is starting to show signs of a pivot. You know, again, it's like turning a battleship. It's going to be a long, slow process. But for the first time this year, over the last month or so, they've started to show little cracks in their hawkish facade. They've started to talk about lagging effects of their previous rate hikes that are not yet showing up in the data. At Jerome Powell's speech last week, he talked about slowing the pace of rate hikes going forward. And these are all good signs for a market that is desperate for the Fed to stop hiking rates and let the dust settle a little bit on the rate hikes they've already done this year. I mean, the Fed has already hiked rates 375 basis points just this year. That is an unprecedented velocity of rate hikes. So the market, the economy, everyone is really hoping that the Fed slows down and comes to a stop soon, and then eventually pivots sometime in 2023 back to cutting rates and injecting some more liquidity back into the economy. That's all I've got for today. If you enjoy the content, please hit like and subscribe, and be safe out there. We'll see you next week.